So let's talk about setting up the business. There are a couple different kind of structures. I'm going to go through these all quickly, and then we've got information on all of these. The first is there's a sole proprietorship. The second is a general partnership. There are limited partnerships. There are LLCs. There are S Corps, and there are C Corps. And then there are specialized entities like an LLP. We're going to go over what each of these are right now and then figure out which one's going to be right for you. By the mere fact that you're doing business, that you provide a product or service that you charge for, you're a sole proprietor. So if there is any product or service that you are charging for, that you are providing, congratulations, you are already a sole proprietor. There is nothing to file, there is nothing to do, you just are. Now you'll need to disclose all the information for your taxes when it comes to your income, but there's nothing specific that you need to do with a sole proprietorship. So what kind of businesses are sole proprietors? Businesses of one. So a lot of times an attorney or a plumber or a consultant will be a sole proprietor. They're in a business of one. And what most often is done with sole proprietorships is that there's two key things that you need to be compliant as a sole proprietor. One is you do still need to get a business license. So your city or county will require that if you are in business, engaging in business, that you get a business license. In our case, it doesn't require anything more than Googling Los Angeles County, Los Angeles City business license. They're typically not that expensive. And second is, if you don't want your sole proprietorship to be identified just as you personally, then you get what's called a fictitious business name or a DBA, doing business as. And what that allows is, most notably, on the checks that you give to people and that you receive, they're not going to write it to an individual, but they're going to write it to that DBA or fictitious business name. So for example, our family has a business, and our family's business is that we own a little bit of real estate, some apartment buildings. And in our case, my dad never set it up as an LLC. He never set it up as a C Corp, as an S Corp. He had it set up as a sole proprietorship to start. And he had a DBA, a doing business as La Sepulveda Apartments. And when he writes checks out for the business, and when he gets checks in, people write it to La Sepulveda Apartments, and that's the name against his checking account. And so those are the kind of key things for the sole proprietorship. Again, sole proprietor, nothing there. A general partnership, again, no documents, no anything needed. The key thing there is that if you and I start working on a business together, we have an agreement, a partnership agreement, what percentage of the business is mine, what percentage of the business is yours, who the profits go to, and then we just need to reflect that in our own personal income tax returns at the end. But there's nothing to file with the state, there's nothing to file with the city. Again, you might want to get a DBA or fictitious business name, and we'll go through the other filings that you'll have to do. In both a sole proprietorship and a general partnership, the business owner has primary personal liability. So other than getting insurance, if someone is suing the business, they're suing you personally. And that's the reason why people often want to get some kind of corporate entity, so there's some level of protection. So for example, Nikki, in your salon, let's say you just run it as a sole proprietor. And somebody comes in one day and a freak accident happens and they get burned by a hairdryer. And now this person wants to sue you. If you're set up as a sole proprietor, then they are going to sue you personally, which means your personal assets are liable in that suit, which is why a lot of times people want the protection of a corporation. And so the most common vehicle that's used for especially, it's a very straightforward, simple vehicle that's very popular, is a limited liability company. And what a limited liability company, an LLC, provides is it provides the protection of a corporate veil while having a lot of the ease of the transaction of a sole proprietorship and some of the tax benefits as well too. So first off, I'm not a practicing attorney, and I recommend that you get this advice from an attorney in more detail or before you go to actually form your corporation. But I'm going to give you a bit of a background on each, and then we're going to go into the resources. We'll have a lot more. What an LLC is going to provide is the following. Is if Nikki's business is set up as an LLC, she's got the protection of the corporate veil. So somebody's going to go to sue her. They're not suing Nikki personally, but they're suing the LLC, which means they can only get as much as the assets that they have in the business. So your personal assets, cash, the property that you own is over here, and here are the business assets, and you're protecting your personal assets. So the value of an LLC is that it's an easy vehicle to use. It's a low setup fee. It's about, in the state of California, about $800 to set up, so it's pretty straightforward. It provides you the protection of a corporate veil, and for tax purposes, it's straightforward because it's a pass-through tax entity, which means you're only getting taxed on your own personal income for the amount of money that you personally take out from that LLC. Now, there are issues around commingling. You need to be careful that your LLC isn't run like your own personal affairs. If you don't have a separate business and checking account, then somebody suing you can make a case to pierce the corporate veil, which means that they're saying that, look, this isn't really a business entity, it's just an extension of the person. But as long as you keep your books and everything in order, then you should be fine. And what's the right kind of business for an LLC? Well, an LLC is very good for a salon. An LLC is very good for any kind of retail business. An LLC is very good for if you want to hold property in like real estate and have an extra level of protection. For a consultant, if you want to start a consulting firm, an LLC is a really good vehicle to be able to use that for as well too. Let's jump ahead to a C corporation. A C corporation is, and by the way, you incorporate either an LLC or a corporation, it's the state that you're based in. So every different state has their own set of incorporations, something you do at the state level, not the federal. So there is no federal incorporation. You always get incorporated in the state you're in, and the primary rule is where are you mostly doing business and where are your customers at. A C corporation is the vehicle that pretty much every public company uses. Right? They have shareholders, they have board of directors. So let's talk about the basic breakdown of how corporations work. In a corporation, there are three main classifications of folks. They're the shareholders who own the stock. The shareholders elect the board of directors. And the board of directors are the ones that are ultimately responsible for all the decisions in the company. And then the board of directors put in place officers, a CEO, a COO, a chief marketing officer, to run the company. Now, in smaller companies, one person may be all three. You could have a C corporation where you own 100% of the stock, you're the only board member, and you run the company. In that case, you're the shareholder, you're the board member, and you're the primary officer of the company. And that's not uncommon at all. In larger companies, or even as companies grow, for example, in my company, since we took in a lot of professional investment, we have a board, we have various shareholders, we have a venture capital firm, we have about 10 angel investors. So those folks are all the shareholders, plus all the employees, since they all have stock option grants in our company. So we probably have roughly around 60 shareholders in Docstoc. Then there are the board of directors. There are 5 board of directors. Three of them are investors. One is me, and one's an independently directed board of directors. That board of directors ultimately decides who the officers are. So even though I started Docstoc, I don't own a majority of the company anymore. And if the board didn't want me running it, they could replace me and put somebody else in. And so that's one of the things that we'll get to later on, which is when you raise professional investment, like angel investment or venture capital, if you don't own 50% of your company, it's not really your company anymore. And I, believe it or not, even though I started this company and I put in a lot of my capital to start, I don't own a majority percentage. My co-founder and I don't even own the majority percentage together anymore. And so we really serve at the guidance of the board. Now the board I'm also on, and there's other people on, but it gets to be a little bit more complicated. And then there's the officers in the company. So in a C corporation, the reason why people elect to have a C corporation is it's typically the kind of company you want if you're going to go out and raise money. And the reason is it allows for the most easily amount of investors. With an LLC and with an S Corp, which we'll talk about in a moment, as you get more and more investors, as you want to get 50, 100, 150, 200 investors, it gets more complicated. C corporations are also perceived, because they have more rules and processes around them, to provide the most amount of protection to separate personal assets from business assets. Now, the key component of a C corp is that with a C corp, there is double taxation. So Nikki, let's take your business again, and I'll answer the question in just a moment. Let's say you set up your business as a C corp, okay? And you gross that same $500,000 in revenue, and you've got $400,000 in expenses. And a part of that $400,000 expenses, you paid yourself a salary. Let's say you paid yourself a salary of $50,000 a year. You're going to pay taxes on your $50,000 a year salary, okay? But the business that made $100,000 of profit is also going to get taxed at a corporate rate. So you're paying double taxation. You're paying the business profits, corporate tax rate, and then whatever you make personally, whatever you pay yourself as an employee, whatever in typical salary or salary and bonus, you pay at a personal level. So compare that with an LLC, which is the business gross is $500,000, and let's say you took out the same $50,000 throughout the year, but then the $100,000, that gets taxed to you at your personal level. So that may be of benefit to you, or it may not, but in that case, you have $150,000 of personable taxable income versus the C Corp, which is going to have $100,000 of taxable income at the business rate, and then you've got $50,000 of taxable income at a personal level. So most notably, one of the advantages of using the LLC is that as long as your expenses are related to the operation of your business, you can reduce your tax liability because you can write off more of your expenses. In a C Corp, once you've paid yourself that salary, you're going to get taxed at that personal rate, whatever your salary was, and the business is going to get taxed at that rate too. Maintaining a C Corp is also more complicated than an LLC. There's more filings you have to do with the government, with the state. You typically have to report, keep track of minutes that you have of your meetings, and keep those recorded as well. There's more paperwork, there's more filing, and there's a little bit more expense that's associated with a C corporation related to an LLC. You can start in as an LLC and then switch to a C Corp. You will incur more legal expense later on. So if you're relatively sure that it's a business that you're going to raise money for, and let's say you're going to raise more than $1 million and have more than 15 shareholders, and you want to sell that business, my general recommendation would be go straight to a C corporation. But you can convert from an LLC to a C Corp. It just costs more money in the legal process. An S Corp is a bit of a hybrid in between a C Corp and an LLC, where it's a pass-through tax entity, but it only allows for a certain number of shareholders. So before LLCs were invented, which is a relatively new corporate entity that was created in the last, I think, 2 or 3 decades, and became popular, or it became popular in that time, S Corps were the vehicles that people would use to not get double taxation. These days, most people go through LLCs. So for your situations, what do you actually pick? My recommendation would be not to work in a sole proprietorship to get that extra level of protection. If you are a retail business, if you are a consultant, if you're, for example, a lawyer or accountant, sometimes you'll usually get an LLP, a limited liability partnership. If you are selling products online, my recommendation is set up an LLC, because the extra money that you're going to pay and the little bit of extra paperwork you have to do is going to be well worth the protection that it's going to afford you in the long run, as long as you make sure not to commingle your personal accounts with your business account. If you think that you're going to start a business where you're going to go out and raise lots of money, and you're going to want to get in excess of 20, 30, 40 shareholders, and you want to have some kind of liquidity event, you want to sell that business, or you want to take it public, the better vehicle is to just go straight into a C Corp. And what a lot of people do is they'll get a C Corp based out of Delaware, but then you also have to apply to the rules of the state that you're in as well, too. There are fees associated with each one. In the state of California, an LLC has a gross receipt tax. So I think something like up to $250,000. Anything you make less than that, you don't have any additional taxes. But then it's a tiered level after that where based on your gross receipts, not your profit, the gross receipts, you owe a percentage of that. And that's varies state to state in terms of what you have to pay. So your main choices that you're probably going to have to decide between are an LLC and a C corporation. And we went over the pros and cons there.